Hello guys, and welcome back to the Cedi Investor. So in today's episode, I'm going to give you my thoughts on the two petroleum companies in Ghana. We're also going to go over their performances. I have their Q2 statement, so we'll go over that. And at the end of the video, I'll give you my overall outlook on petroleum companies. Let's get into it. Depending on what type of investor you are, you might either love petroleum companies or not. Now, me personally, I don't own any petroleum company in any of my portfolios. I don't own it in the Cedi Farm portfolio, and I also don't own it in my main portfolio as well. Personally, because of my own investment strategy, I tend to stay away from petroleum companies, especially in Ghana. These are businesses that are low margin. So out of every revenue that they are able to generate, it's just a little that's being left as profit or even cash flow for shareholders. So they tend to be low margin businesses. Also, when it comes to petroleum company, these are companies that depend heavily on global prices of oil and also the Cedi performance. So when we see Cedi depreciating massively, we tend to see fuel prices going up, and the same can be said when Cedi is having a massive appreciation. And because of this volatility and unstableness in the prices of both the Cedi and global oil prices, which is dependent on demand and supply dynamics, sometimes the prices of fuel in Ghana tends to be unstable. So their business model is in a way that it really depends on these things. And like I said earlier, they are low margin, so there's not really a lot. Even though their revenue might seem huge, there's not really a lot when it comes to how much they're actually sustaining. And for me, I don't only want to see my businesses growing their revenue, but I want to see it growing at a very fast rate. But one thing that I would say is that if you're a dividend investor, the two companies that like to pay out dividends a lot in Ghana, and I think they've been very consistent with their dividend payments, are the two petroleum companies. That's Total and Goil. So for me personally, it doesn't fit my investment strategy, and probably maybe might change in the future, but then maybe dependent on how you invest, it could be good for you. Up next, let's go over their performance, their Q2 statements, and we are going to compare the two of them. They are in the same sector, so it will make sense to compare to see which one is actually performing and which one is actually worth it. Starting off with Total Ghana. So we can see that their revenue increased from 3.3 to about 3.6. And at the end of the day, they made more gross profit than they did in last year, 2024. That's for the Q2 period. But based on what I was saying earlier, we can see out of 3.6 billion in revenue, they only made about 467 million in gross profits. So that would be like about less than 10% gross profit margin. Operating profit increased, and profits after tax also increased. So all in all, they are making money. I think earnings per share went from 1.01 to 1.48. So they are growing their earnings per share and their profits for investors, which is very, very good to see. But then in terms of the margin, how much they are able to sustain, and I'm not saying like it's even a bad thing, because that's the nature of their businesses. It's the nature of that particular business. So most petroleum companies are already low margin. So they is like, well, I think total comprehensive income would be about less than 5% margin in terms of how much they were able to sustain from the revenue. Now, when we take a look at Goil's revenue, we can see that it actually went down from 9.6 billion to 9.3 billion. It is the same story for their gross profits, very low margin, actually making way less. But in terms of sundry income or other income, they were able to still make more operating profits compared to last period. So at the end of the period, their earnings per share went up from 0.1 to 0.18. All in all, very low margin, and even in terms of revenue, their top line is actually moderating a little bit. Now, when we look at sundry income, I wanted to really go through it to really understand why this particular income went up, because this was the main reason why they actually ended up increasing their earnings per share and profits for shareholders, because when you look at the actual revenue, it went down. And we could see that miscellaneous income was the main reason. It went up from 19 to 38 million. And that really it doesn't really explain anything. What is miscellaneous income? So I think they should have given more emphasis as to what that particular income was. I don't know what miscellaneous income is. It could be anything. So yeah, when you look at how these companies are being run in other countries, especially the US and Europe, because these companies usually are low margin companies, meaning that they retain very, very little, from the data, about 5 to 10% of what they make for shareholders. They don't really focus on fuel purchases as their main revenue source. Their filling stations is usually the way to get in consumers, but then what really makes them more money is the, should I say, other segments of their businesses, which is normally combined to the filling station. So things like restaurants, convenience stores, washing bays, and a whole lot. I know if you are driving by a fuel station, you should notice, apart from the fuel station, there's a whole other cuts of businesses that are combined to most fuel stations, like convenience stores, restaurants, washing bays, others. Like I'm sure you've noticed them. But in Ghana, those segments or other sections of the business also don't make a lot of money. I don't even remember the last time that I personally went into a fuel station convenience store to buy something. Maybe I could be wrong, but I don't know. You guys should be a judge of that. Now, finally, I want to end up this video with, is these companies worth it? Is Total Ghana worth it? And is Goil Ghana worth it as well? Because after going over their performances, it's not only based on performance that we used to judge a company, but it's also based on valuation. So for me, I feel like there are two main things to look at when it comes to risks for businesses. We have fundamental risks and we have valuation risks. What are fundamental risks? Fundamental risks will be things like, the core operation of the business is failing. The management are, useless. They are not really doing a lot. Revenue is not going up. Like the core fundamentals of what makes up their business, free cash flow, whatever, is not growing or is failing, or there's some, sentimental issue with the branding of that particular company. That will make up fundamental risks. Now, just because a company is fundamentally strong does not mean the risks end there. We also have valuation risks. Are you buying that particular company at an expensive price, or are you getting it at a discount or a fair value? You can have a very strong company that you are very interested in, but you can overpay for that particular company. What do I mean? If the company, based on its fundamentals, is a strong company, but then shareholders have priced those strong performance into the stock, and the stock is trading at a high multiple compared to what its fundamentals are, and even compared to how fast that particular company is growing, then at that point in time, you are overpaying too much for that particular company. So let's take a look at Total. Total earnings per share for the trailing 12 months is 3.08. Their P ratio is about 10.38. It is up about 143% this year. It started off the year at 13 Ghana cedis and is now trading at 31 Ghana cedis. So if you bought the stock at the beginning of the year, you would have more than doubled your money. More than doubled your money. Now when we take a look at Goil, it's trading at 2.31 Ghana cedis. Year to date, about 51%. So you'd have made half of your money if you had invested at the beginning of the year when it was trading as 1.5, and now it's trading about 2.31. Its PE ratio about 9.08, earnings per share about 0.25. When we look at the earnings per share growth, it has been quite bad, but over the past 2 years, they have been actually growing it by about 52. Now trailing 2 months about 109. An interesting thing that I actually want to show is that free cash flow per share Over the past 3 years, they actually have been losing money. So the company is not making money for shareholders. They've been losing money over the past 3 years for shareholders, despite continuously paying dividends and stable dividends too as well. So I don't think it's very consistent when it comes to this. They have to start, generating actual free cash flow for shareholders, or the dividends will probably be slowing down in the near future. However, the story is very different for Total. We can see their free cash flow per share is actually growing massively too as well, quite good, and they are also growing their dividends per share. This year a little bit less compared to last year, but at least it's better compared to dividends. So they have some wiggle room to actually sustain dividend payments over the next few years if they continuously maintain the free cash flow that they are going for their shareholders. If you take a look at their PE ratio over the past 5 years, we can see it's trading at all-time highs. For Total, it's trading about 10.38, which is the highest in its history, and that's quite a large, so meaning you are probably buying this company at a high valuation. And the same is also true for Total as well. It's trading at a PE of about 9, not the highest, but then it's quite high, so you're also probably buying this particular stock at a high valuation. Even if you compare it to each other, Total, based on its performance, I don't think it should even be close when it comes to its PE ratio. It shouldn't really be close to that of Total. And so I think both of them are trading at high valuation. Now, to drive my points further, we can see that we have MTN's PE ratio here. It's trading at 8.05. And we also have GCB, one of the biggest banks in Ghana, trading at 1.64 PE ratio. So these two companies, one company is a telecommunication company, growing very fast. Its earnings and free cash flow for shareholders, it's high margin business, so they are able to sustain a lot of the revenue that they make as profit for shareholders. And the company is growing very, very fast, especially in every segment of the business. Even when you look at JCB, one of the biggest banks in Ghana, it's also a company where it's continuously growing its revenue. There's a little bit of concern about low interest rates, but when it comes to its income, it makes way more compared to the four companies, and it's trading at about 1.64. Its PE ratio is very, very low. Now, for banks, they are highly leveraged, so investors, really price that into stock. So banks don't really have high multiples compared to technological companies like MTN, where they are expected to grow at a fast rate. Banks in Ghana, I'm not going to lie, are one of the companies that actually grow their revenue and also have a lot of money on hand, do a lot of things. Before DDEP, they were very consistent with dividend payments as well. So having petroleum companies which have, some form of unstable revenue source, they are not really growing as much, and their margins are very, very low. Having them with high valuations, trading at PE of 10 and 9, higher than MTN of about 8, and even one of the biggest bank of Ghana about 1.6, even though they are highly leveraged. I feel like what I'm paying for those petroleum companies is too high for the value I'm getting back. So personally, in terms of valuations, I do see that these companies are trading at high valuations. But then, like I said, depending on what type of investor you are, especially when you look at dividends, they do tend to pay out dividends more often. For Total, I can see them consistently raising their dividend a little bit and continuously paying dividends. But the story is a little bit different for Goil, since they have not even been generating money for shareholders. Their free cash flow has been negative for the past 3 years, and trading at a high valuation of about 9, very close to Total, whilst not generating money for shareholders. So personally, I do think that it's even trading at a higher valuation compared to that of Total. And from even their performance, Total is a company where, even though it's trading at high multiples, its growth is actually more sustainable compared to that of Goil. They have been actually a little bit more efficient, and they have been trying to grow their revenue. But that is just my opinion. Let me know, comment down below what you think. Probably you have a different outlook compared to mine. But yeah, I think that's the end of this video. Thank you so much for watching. Like this video, subscribe, and share to people you think might be interested. I will appreciate it very much. And until we meet again, have a lovely and blessed rest of your week. Peace.